I would like to introduce Meg Bodie, the founder and president of Talking Hedge Events. Meg, over to you.
Okay, great. Thanks a lot, Ken. And hello, everyone. We have a terrific audience signed up for today. We're really excited. This panel is all prepped. Great agenda for all of you today. And I think it's going to be pretty lively. So welcome to the second webinar in our fall series, which is replacing our trip to Santa Monica. But we do have a couple of people in California who are on this panel today. So we're happy to have participation from the West Coast of the U.S. And we have quite a few people north of the border from Canada, and we thank you for joining us as well, and some from Europe and the UK and so on. And so this is all really terrific. We really like to be very lively. Many of you know that. So I just want to mention that the speakers' insights and opinions and stories are really their own, more about who they are and who they've become through different roles in the industry, and not necessarily reflective of the opinions of the companies that they may be working for now. So please bear that in mind. But I want to thank our supporters. I want to thank Graham Capital for coming to us with this idea. Really excited to have Chris Jones with us from the London office today. I want to thank Martlet Asset Management, and we have Judy Posnikov with us. She's one of the folks in California, getting up early to be with us. And I want to thank State Street. They're going to do something with us in early December. Happy to say that. Bodie Research Group. Also, we have, I got to look at my cheat sheet here. O'Brien Investment Group going to hit cryptocurrencies again with us in December, and Vidrio Financial. And Vidrio will be up next in 2 weeks on November 19th to talk about the results of a survey they've recently done with institutional investors on ESG sort of best practices and implementation and things of that nature. I also am very grateful to our association partners, AMA, CASA, and Kaya. All terrific stuff. Thank you so much. They help us get the word out, and those are great relationships. And our other California participant is Stephanie Friese from Barclays. I'm very happy to introduce Stephanie. She's going to lead this discussion and have all of the other panelists introduce themselves in a second. So Stephanie, please take it over, and thank you.
Oh, thank you. Well, thanks, Meg. On behalf of all of us, we really want to thank you for taking the time to be with us today. We know you have a lot of competing priorities, so thanks again for being with us. My name is Stephanie Friese. I'm a managing director at Barclays. I'm based out of San Francisco. I'm part of the capital solutions team within our prime brokerage group. Today we have truly an amazing panel, true trailblazers and innovators in the managed account and customized solution space. Our hope today is that whatever your role is in the industry, that you come away with something. A new idea, a fresh perspective, a new strategy to deploy. So here's today's format. We'll take a few moments for the panelists to introduce themselves. I'll then kick off the conversation with some questions to, get some trends and themes going of what we're seeing in the space. We'll then, have a look at the poll results, and we really do hope that the audience does send in those questions, and we'll be keeping an eye on them. So please, anything fair game, and we will get to it our best or follow up after the panel. So with that, Ella, Judy, and Chris, welcome. Good to be together again after this whole week of prepping for the panel. If you wouldn't mind, please providing a brief intro of yourself, your firm, your role, that would be great. Ella, maybe we could start with you.
Sure. Thank you. And I'd like to thank Meg and the sponsors for actually having us today. This is one of many events that I've attended. It's always great content, and I'm flattered and very happy to be here. So with that, just maybe a couple minutes on my background. I started out just to talk about my career evolution. I started out as a currency and bond trader in Turkey in the mid-90s. For those of you who are trying to do the math, I started when I was 5 years old. I went on to work in credit derivatives and asset management at Merrill, and In 2005, I joined a New York-based quant macro fund where I led portfolio management trading, quant research, which really is where I started seeing all this customization. And that's where I also learned a little bit about the institutional landscape. After 6 years, I returned to Canada, joined Mercer as a senior manager researcher to cover absolute return strategies, and saw a little bit of the bigger picture. Since then, I've been on the institutional side. I joined WSIB investment team, which, as some of you might know, eventually became IMCO, where I managed a $10 billion multi-asset portfolio and later on oversaw the entire WSIB portfolio. And that's where we did a lot of customization. In my most recent role, I led the total fund management team at BCI, which, as most of you probably know, is one of the largest pension managers in North America. It manages roughly $200 billion. So that's the AUM across 30 plus clients. So it's a multi-client structure. I'm currently providing advisory services to institutional investors on total portfolio approach and alternative investments since I've left BCI. Thank you.
Ella. And Ella and I met because I've been covering Canada for many years. So we date back to the Mercer days.
Let's not date ourselves.
Judy?
Sure. Well, I want to echo Ella's thanks to Meg and the sponsors for providing the format for today. But I'm Judy Postnikoff. I got into the hedge fund business back in the 90s after being in academia for a few years. And I found it very, very interesting because particularly in the hedge fund space, there was always something new, a new security, a new way to trade it, something new always going on. And the people were quite characters at that point in time. So I really enjoyed it. So I was one of the 4 people that started PAMCO back in the year 2000. And we built that as a major fund of funds, particularly focused on institutional investors. And then in 2019, we started, a subgroup of us started Martlet Asset Management. But right now we're doing a lot of advisory work, special projects for institutional investors.
Great. Thanks, Judy. As I mentioned, true trailblazers and innovators on this panel. Chris?
Thanks, Stephanie. And to echo the words already spoken, thank you very much for having me here. So I work at Graham Capital. For those of you that don't know Graham, it's a $17 billion fund, 27 years old, 170 people. And we focus on systematic macro and discretionary macro, including trend following and CTA. So my job at Graham, I run the London office. I'm a co-head of institutional relations, but I think the most pertinent role I have at Graham for today is I work within the quant team on client solutions. So I have a particular responsibility if a client comes to us and wants some form of customization or partnership to work out what fits best for them. That's what I work on. I'm quite new to working on the single manager side, having spent 20 odd years on the allocator side. I started off on the allocator side in the 90s, and just like Ella was nothing but a child back then, and really kind of worked as CIO of a fund of funds, key asset management, head of advisory for an investment consultancy, B Finance, joining Graham in 2016. I also work on the academic side from a similar background to Judy. I still have a fellowship in the University of Cambridge where I teach hedge funds and sometimes risk management in the business school. And I did a PhD back there at the dawn of time on systematic trading.
Great. Thanks, Chris. As I said, we have lots of expertise on the call today and, a lot of things to get through. So let's start there. So would love if each of you can touch upon the evolution that you've seen in the level of customization in the managed account space and where we are now. Judy, would you mind kicking us off?
Sure. So just what I've seen over the past 25 years or so in terms of customization is that, at least for us, when we did custom portfolios, we always did it within a limited liability wrapper. So it was always an SPV of some kind. And in the very early days, what it tended to be would be a share class of a fund that was already established by a manager. And typically, in those days, it might be that we would have a quant fund that was really good, but returns were probably in the low single digits. And so we would add leverage in that share class. And it was technically open to others, but it was really doing the customization in terms of what we wanted. And then, things moved on and we moved to doing funds of one. And that's where a lot of the customization really came in. And that gave us the ability to obviously get specific terms that we wanted. And also if we wanted to use leverage or we wanted to concentrate in a certain area or take a certain exposure out of the portfolio, it gave us that ability to do that. And then in 2005, I think we were a little bit early. We set up an internal managed accounts platform. And I would say that we got all of the benefits that we had before, plus then we had actual control of the portfolio. The managers did the trading, but we did all of the back office and everything there. And then we also had the sort of what I would call the efficiencies of scale at that point, in terms of dealing with the prime brokers and, all of the other counterparties as well. So it's sort of been a long road in terms of customization, kind of going from, exposures and positions in the portfolio to really having the control of the portfolio sort of there near the end.
Thank you. Ella?
I think it's very similar to what just Judy described. Obviously, I can't speak to pre-2000s as I wasn't actually in North America and I wasn't following the market at that time. But between early 2000s and 2008, there was some level of customization, both on the manager and institutional investor fronts. But it was really limited. Case in point, when I joined this New York-based hedge fund, the quant hedge fund, in 2005, we directly started out with separately managed accounts, same as Judy's mention of managed account platforms. And so from the manager side, while we were doing that, the investors actually were structuring it in a managed account platform, although it was really a very novel approach at the time. Not many people used it. The commingled fund vehicles, at least from my perspective, really came into picture in 2010 or later, or fund of ones. The reason why SMAs were really favorable is because investors wanted to own the assets in segregated fashion, and this trend became even more ingrained as after GFC, when a bunch of managers actually, as you know, went belly up. So the burden of portfolio construction at that time was really on the institutional investors. So managers didn't really do too much to actually contribute. That said, some institutional investors were catching up to the trend. One such plan in Canada that contributed into spearheading a lot of this evolution of manager customization, particularly in the absolute return space, is one that I've closely followed. It was Ontario Teachers. And pre-GFC, they were already teaming up with their managers, expecting them to step up on multiple fronts. And reason was not just risk management. It was also liquidity, but also enhancing the portfolio construction and risk-adjusted returns for the absolute return portfolio. That said, a big chunk of the assets in the institutional landscape was still in commingled vehicles. I'd say up until maybe 5-6 years ago. Then I think investors really started switching into more customization, more direct investments, more strategic relationships. So if you look across, say in Canada, the pension plans, you'll see a lot of people or teams manage these strategic relationships. There are groups actually dedicated to this. So the reason I think the question is, why did all of this happen? Because that just informs us as to where we're going. I think there are 3 reasons why this customization happened. One, it was the low for long environment where there was an extended equity bull market, that anything that competed with equities looked dismal. So you had to come up with new ways of doing things. Second was the proliferation of the asset management land, where a big chunk of the alpha became beta. And if alpha is a zero-sum game, too many managers chasing it. So it was very difficult to actually source, harvest this alpha, and it was very expensive. So people had to come up with new ways of doing things. And lastly, it was the move towards total fund or total portfolio approach, which was all about portfolio construction and the value add at the total portfolio level. So this is where we are. And I think the last question is, where are we going? And I think it's a little political answer, but I think there are 2 pathways. So if we have a continuum of equity bull market, then I think the active management will be relatively more difficult on the upside. So manager selection, I think, will lose its significance in portfolio construction. And so we would see more index type beta strategies. It would be fewer active managers. The reason being pie available to the asset managers will be, I think, smaller, and it will be survival of the fittest. So only those managers and providers who can actually be integrated into the portfolio teams, internal teams that can team up and be an extension of these teams will survive it. The alternative is, it's still going to get to the same place, but it could be slower. If there's a decent correction in the markets or there's a decoupling, then the manager selection will have a renewed importance in the institutional portfolio and the hurdle will be lower. I think the customization will go slower, but regardless, I think we're just going there.
Great. And just a quick follow-up, Ella, do you recall what the size of the managed accounts were when you were at that fund?
It was actually relatively small. We were managing assets that were, we started out opening SMAs with less than 4 million. And today, if you look at any SMA, you're not going to get in if you're even 50 million because it's not really worth, right, the effort. The client that had, if my memory serves me right, it was around 100 million. And it was part of a structure. We were actually trading under the same FCM and the cash was being managed as such. So I was a very interesting concept because I didn't see it anywhere else until maybe 10 years later.
Great. Thank you.
You're welcome.
Chris?
Yeah, when I started in the 90s, I worked at a branch of a company owned by Credit Lyonnais Rouse, and we were all about managed accounts. All our manager allocations had managed accounts. And I was looking through some stuff recently and found the old trade journal managed account reports. And it had a special focus on a very small set of managers, focus on managers with assets greater than 50 million. And so it shows how the industry has really matured since then. And so naturally, the size of managed accounts was so much smaller then, and people would do a managed account for $5 or $10. I think really kind of the evolution, though, kind of customization has been one over the last 30 years or so. Certainly kind of when I ran Fund of Funds in the 2000s, investors really viewed, for right or wrong, hedge funds as an asset class. There was a decision made by the board to invest in hedge funds. Maybe there was some kind of a prescription at strategy level, but there was very little kind of customization at strategy level. And really kind of, I think, post-GFC, investors started to specify a bit more about which strategies they wish to invest with. And as this relationship between investment manager in the hedge fund world and investor matured, and investors were able to see what was capable and managers were able to respond to that, then the customization grew. At Graham, things started out, and half of our business is managed accounts, or almost half. And so we do a lot of kind of working with clients to support them in building managed accounts. But at the start, the customization was pretty small. It was turning a dial. It was maybe having a higher vol target for capital efficiency, or to get the right vol that fitted in with the rest of the portfolio constituents. Maybe it was kind of having a foreign currency managed account, so everything swept back into, British pounds instead of the dollar. Maybe it was restricting one or two markets, or having something X commodities. And then kind of things evolved more. We then kind of worked on projects for clients where they wanted to cap equities in some way. We found the much more effective way to do this than just removing upside equity exposure was to cap the beta overall in the portfolio, so that equity exposure doesn't pop up in commodities or elsewhere. And this is something you can do very well on the quant side. The way we have our quant approach set up is the last stage is the portfolio construction architecture, the constraints, the optimization, the risk overlay. And so because this is the last stage, you can put in any sensible constraint or cap and still end up with an optimal portfolio. So it's not ripping something out of the portfolio and having kind of a suboptimal remnant. It's kind of optimizing the portfolio with that in mind. So we can do that very kind of effectively for clients. But then things have evolved further, as well as kind of caps on beta, for example, or having kind of certain markets removed. There's also kind of hybridization as well, working out which kind of best combination of strategies work together. And again, you can net the signals and have an optimal portfolio there. And capping beta doesn't have to be 0 either. It could be 0.3, 0.5, whatever fits best to the portfolio. So every step in that direction is a step towards further customization. And as we'll come on to, kind of completion funds as well. It's kind of working out what's that gap in the client's portfolio and what's the best fit for it. The final evolution really we've had is more on hybridization, but not just sticking to our alpha strategies. Kind of working with clients to work out exactly what they need for a certain role, very much outcome-oriented investing rather than kind of strategy selection. So we can kind of add our alpha strategies, we can add optimal baskets of assets, we can add volatility, exposure, and so forth. And really, what was once just turning a single dial is really sitting down with the client with a deck of dials. And for some clients, they'll say, look, we want you to kind of do this for us and give us work out what our best fit is. But for many investors, it's like, look, let's work on this together in partnership so we can get something that's not just kind of a good fit, but is pretty robust going forward as well. It's so easy to over-optimize that it's important, I think, to have that honest relationship with the clients of what is achievable and what is kind of pushing things too far, because everybody wants robustness and they want things to work. So the steps have been from simple volatility tweaking or removing markets right the way up to kind of giving our full deck of strategies and more to build completion portfolios or portfolios there that are there to develop a very particular outcome.
Perfect. Thanks, Chris. I definitely have some follow-up questions for you, but I think I'll reserve it till later when we talk more about completion portfolios. Thanks, everyone. If we could pull up the poll results and we could all take a look at them. Okay, great. So it's a breakdown of the audience. Seems like we've got, half of the audience are fund managers, a quarter are investors. Construction approach. Okay, strategic asset allocation, roughly 50%. We're going to touch on that next. Okay, close to over 60% are using or offering customized solutions, co-investments. And then inflation, yep, we're in the thick of it now, 67% of the group. And investors now, what are we? Okay, risk mitigation, zero correlation, and ESG. Okay, great. We plan to touch a little bit of all of these topics as we move along into the panel. So the next topic, and Ella alluded to it before, very topical today is the discussion around using total fund approach versus strategic asset allocation and portfolio construction, and the implications on the level and type of customization required. Judy and Ella would really appreciate your thoughts here. Maybe Judy, we could start with you first, and then Ella.
Sure. Well, I thought it was interesting, the poll results there, that the total fund approach was lower than the strategic asset allocation approach. And I think that's just sort of a historical remnant that I think a lot of people are sort of moving, maybe a little bit slowly, but moving more to that total fund approach rather than the strategic asset allocation approach. And I think it's interesting. We can talk a lot about things on the investment side, but I think the total fund management approach really sort of changes the organization in terms of doing it, because what it does is it has what you're doing is you're taking a look at the whole fund, obviously, rather than asset classes. So then when you start talking about the senior investment professionals, you're talking about generalists in most cases rather than specialists, because again, even though you may be looking at a particular asset class, you're still thinking about things in terms of the overall portfolio rather than just your bucket or your sector. And so that gives you someone that needs a much broader focus on what's going on there. I also think that when you get down to the portfolio level, you do have a very different looking portfolio. And in one simple case is you tend not to have as many external managers as you do with the strategic asset allocation approach. Because again, you're looking at the overall portfolio and you won't have sort of multiple exposures of maybe the same type, across the different buckets. Again, looking at the overall portfolio, you'll sort of see that, and then there won't be the need for it. One of the other things is that I think there's more of an opportunity to use overlays with the total fund approach, options in some cases, risk mitigation strategies, and so forth. And again, because you're looking at that overall portfolio rather than just your bucket, you're really focused on where does the overall portfolio have holes and how do you solve it. You can do that with the strategic asset approach, but it's much harder to do because to sort of solve those problems, you've got to take it a little bit money away from one area for the other. And, then that sort of creates sort of internal political pressures to do that. And the last thing I'll say that I think is interesting is that the large investors that have moved towards the total fund approach have reported significant savings in the investment costs. And a lot of it is the reduction in the number of overall managers that they've got. And therefore, you've got larger, sort of more concentrated relations with them, probably better fee terms and so forth. But there's definitely a savings that we see there with the total fund approach.
And Judy, just as a quick follow-up, with the generalists and the specialists and the staffing, who are you mainly dealing with at the at the plan? Is it the CIO, the head of risk, or is it?
That's an interesting question. It tends to be a number of different people. So it will obviously be the CIO in most cases, and then his or her staff, that's directly supporting. And then risk comes in because it is taking an overall look and where a manager can actually help to offset perhaps some risk. You'll bring in the risk manager there and look at it. But again, it's taking that overall portfolio approach. And I think it also has implications for decision making because again, it's sort of looking at the whole thing and everyone's involved in that rather than, making a decision here at one level, then it has to be passed up, then passed up, passed up. And so you get, I think, broader and hopefully more participatory decision making there with the total fund approach.
Great. Thanks. Ella?
Thank you for that. I think, Judy gave a pretty good overview of the total portfolio or total fund approach. And maybe I just want to take it back a little bit to the SAA, because as the poll suggested, there's actually more SAA than total fund or total portfolio approach. And that's actually in line with the current environment where only a handful of investors have actually applied the TPA or total portfolio approach. So maybe just taking a step back to the SAA, what does SAA do? Well, it really takes various asset classes. And for those of you who are not as familiar, but what it does is it looks at the long-term capital market assumptions, say 12% for equity, 6% for bonds, etc. Considers a long-term return target for a specific plan, looks at the funded status volatility. If the funded status is really low, then it goes into a little bit of higher risk, higher yielding asset classes, and then spits out a so-called asset mix. So it's actually pretty good if you have limited internal teams and you have very few asset classes. And it worked really well back in the day because it was very easy to implement, very straightforward. Boards were and still are in charge in most of the institutional landscape. And the investment issues back then were less complex. Now, it's really started changing and TPA started popping up in part because internal teams started to grow. So there's more in-house investment capability. So to your question earlier, Stephanie, it's basically you're dealing with multiple people, as Judy said, because you have a lot of different areas of expertise. You could be, if you're talking about portfolio construction, you're talking to one team. If you're talking about risk, you're talking to another team. If you're talking about the returns or performance or et cetera, you're talking to some other team. So it's gone really complex. And the investment landscape has evolved to be more complex. I think Chris really alluded to that earlier. Where we started off was, let's say, we thought hedge funds and trend following was all alpha, right? But as technology evolved and as industry and the asset classes evolved, now a big chunk of it became beta. So trend following, you can actually get it as beta. And only very differentiated managers are worth the cost of 20 to 20 even if that's even the fees for alpha. So TPA has become very popular because it allows for integrating that information, and it's dynamic, and it's really an immediate asset allocation process as opposed to strategic asset allocation, which is really into the future. And I'm not going to repeat what Judy said regarding how it's asset class agnostic. But I think what's relevant for the conversation today, from my perspective, is how is that going to evolve going forward for managers and service providers? I think what drives this evolution is really the end goal. So SAA is really driven by benchmarks per asset class, and it's all about beating those benchmarks, say by 50 or 100 basis points or whatever it is, depending on the asset class. TPA is more holistic, so it looks at the entire portfolio, and it looks at the risk factors. So asset classes are there, but it's more for optics. Really, you're looking at macroeconomic risk factors such as inflation, real rates, credit, etc. And it's more dynamic, and it basically has the asset classes or teams basically compete for capital. So all investment opportunities are competing, and rather than filling asset class buckets like you would in strategic asset allocation. So it comes with more focus on risk. So you would have a separate group doing that, and it requires more customized solutions. So if you want to get into a portfolio of such, you actually have to have a proposition strong enough to impact not just that asset class, but the entire portfolio. And managers are hired on the basis that they improve the risk-adjusted returns of the entire portfolio. Now, as just we discussed, it's like really the caveat is there are only few plans really doing it, but this is going to happen. It's going to continue happening as the investment landscape becomes more complex. There are more skilled internal teams, and there's more need for dynamic allocations. I will just give one example from my end, because that was one of the questions that actually the answer is very interesting. It's the risk mitigation portfolio framework. This is one of the things I worked at BCI. To be clear, it's not launched and the details are proprietary, so I'm not going to go into the details, but just let me describe the main tenets. Now, it looks like any other strategy, but it's really a total portfolio concept, as its main role is to mitigate the drawdown triggered by whatever the biggest risk in the total portfolio is. So if it is equity, then it really tries to mitigate the equity risk. It reduces the conditional beta of that risk. It increases liquidity and dry powder, and it aims to do this all in a dynamic fashion. So that framework was set up to utilize a combination of passive and active strategies. And that would be ideally run, the active strategies would ideally be run by a handful of managers who would be able and willing to structure the strategy specifically to be used for that underlying portfolio. Very akin to what Chris mentioned earlier. You don't have one dial, you have multiple dials, and only the managers who have these multiple dials will come in and be able to customize it specifically for that entire portfolio. So I think that is the kind of customization that will become more commonplace as we move into the future. Thank you.
Chris, would love to, your thoughts on completion portfolios, as you alluded to before, how you are implementing and, who you're dealing with on the other end of the client. And I'm sure it's like, as Judy mentioned, it's a lot of different people. So would love to hear how you guys are approaching it.
Sure. Well, I think completion portfolios really kind of turns on its head this traditional interaction between investment managers and investors, to be honest. It's always been the case in the past where one side sat on one side of the table, one side sat on the other. Do you like this or that? Then a choice is made and so forth. With completion portfolios, you have to sit on the same side of the table. You have to work in partnership. It has to be partnership at every step of the way. And a large amount of time is spent formulating the problem before you can find the best solution. So we spend time kind of asking questions as much as answering them. And then this makes it sound very high maintenance for the asset allocator, for the asset owner. But it's not necessarily. It could be as high maintenance as you want it to be. We can be prescriptive, but equally we can be responsive to the needs of a client in talking to them and formulating those needs. So step one is definitely kind of sitting on the same side of the table, being realistic about what's possible, formulating the problem in finer detail, formulating the constraints, and these constraints aren't necessarily portfolio constraints. They could be governance constraints. They could be anything. And then kind of really us working with that client to generate a solution with the best fit. It's less manager selection. It's more kind of outcome selection, I would say. There's no best manager for this. It's just which is the best fit for my portfolio. So the best manager is the one that can produce that portfolio with that kind of fit. We're at our best, I think, when clients share with us their portfolio data. So then we can kind of really build an optimal fit, or a fit that we hope will be optimal, based on actual facts of the elements of that formulate their portfolio. But equally, kind of there are stages that sometimes it can be anonymized. Sometimes we can just use kind of headline proxies or whatever. But it's all about really kind of working out where the portfolio is, where it needs to get to, what are the outcomes that need to be achieved, and then working within those parameters and within those constraints to get something that the client, the investor, has confidence in and fits that gap in the portfolio.
Yeah, no, and I mean, you touch upon so many great points, right? So this whole, the idea of partnership in the asset management industry, right? Consolidation. You're selling a solution rather than selling a product. And just a quick follow-up. Are you, with that, I'm sure you've got your existing client base that you're working with, right? And that's, in these days, it's very easy to work with what you have and keep your existing investor base happy. And then when you're going out to other investors and trying to attract new capital, are you targeting certain groups and organizations because there's a structure, there's most likely a potential, like how do you differentiate who you're trying to show the product to versus who you're trying to sell the solution to?
It's a really good question, and I think you can't presuppose who'd be interested in this. I've had conversations that I've had in the pension plan space being pretty much repeated word for word between myself and the potential partner in the wealth space. So kind of problems are problems. Everybody's worried about kind of equities and bonds getting correlated. Everybody's worried about inflation and so forth. So, there's clearly if you're running a pension plan, you're going to be worried about things such as conditional death rates as well. But there are core problems that are universal, I think, to everybody in the investment space. So it's not just a kind of a pension plan conversation. But that being said, I think kind of certainly there are investors who, even if they run a strategic asset allocation portfolio, they still think in a kind of total portfolio way. And so for a lot of clients, it's people who think in a certain way who really have made that switch, as so many asset owners have, to outcome-oriented investing rather than just kind of working out whether they want to buy A, B, or C.
Great, thanks. So a question.
I would just add to that I agree with Chris. I don't think you can determine who would be interested in that based on size. There are a lot of very, very sophisticated smaller allocators out there, or smaller plans in particular, that will be looking for things like this. And it's not just the behemoths, of the pension plan space.
May I just actually add to that? This is a great point. So we did a peer review analysis without revealing who the peers they were, looking at actually who was doing total portfolio approach or total fund management, as well as the risk mitigation. So who was employing it? So exactly to Chris's and Judy's point, there are larger plans, and you'll see very small, like very sophisticated, but relatively small or mid-sized plans globally who are actually applying it. Obviously, risk mitigation means different things to different people. Total portfolio means different things to different people, but it is there, and people are thinking about it. I've seen one group actually doing internal, small group, doing an internal trading to apply and to implement risk mitigation, even though it was the size of a team that once I worked in. But they had the skills and they were doing it, and they were just basically getting pretty good results too.
We have a couple of great questions from the audience, and one is actually on a topic that we were going to cover. So I'm just going to move it up a little bit in the agenda. So ESG is gaining lots of traction and momentum. Couple things. So one, are you currently implementing, and how? And if not, what are you seeing and predicting? And to further kind of dig in a little bit, we have an audience member who has asked about, what's the approach to incorporate this factor into the total fund? So, Judy, could we start with you on your thoughts around ESG, and then we can go to Chris and then Ella?
Sure. So I think the implementation probably is best left to Chris and or Ella. But what I've seen is that a lot of people have talked a lot about this, and they want it in the portfolio. And they obviously, want to exclude a number of exposures. But the problem is I think people are now started to get worried about what's called greenwashing. That it's really not true ESG in whatever space or whatever form it is. And in this case, in particular, the environmental aspects. And they're really starting to think about it. There was, interestingly enough, this month, a professor at Stanford published a paper on divestment, whether that really works, because that's typically been the way things have been done, in the sense excluding things from the portfolio rather than investors working with some of the maybe oil companies or whatever to sort of change their practices. And what they found is that divestment hasn't worked as well as probably has been hoped. So I thought that was actually quite interesting. But that is an area that people are definitely interested in. And I think the allocations have been made. Interestingly enough, there's up until I would say this year and maybe part of last year, a lot of the environmental portfolios really outperformed, but that was because they didn't include energy. And that's obviously changed this year. So performance has changed as well. And, there's sort of, you don't get the sense that it's always a good thing in terms of performance to exclude part of the investable universe there. And so I think some investors will be grappling with that going forward.
Chris?
It's a very exciting time, I think, because there's actually now the instruments available to start to implement on an ESG basis on the future side of things. And being a kind of systematic macro and trend following for a large part of our business, we trade futures. So much so, such has been the growth that I, along with colleagues, wrote a paper on this because it was so startling that things are moving on as they are. If you look at the S&P ESG futures and the Eurostock 600 futures, they've increased in open interest 2 to 3 times. They're starting to get tradable now. They're not kind of obscure little kind of contracts. They're growing quite quickly, and so therefore being able to be started to be implemented in portfolios. It's still small. I worked out in the paper that we wrote that if we were going to entirely replace our equity index future exposure with the 2 most liquid contracts, you could manage a portfolio of around 100 million. So, it's not $1 billion, it's not 10 billion, it's 100 million, but you could still be kind of pretty light footprint by doing that, being under 30% open interest and so forth on a day-by-day basis. But, the implications are there that if this growth continues, if you were to, for example, on a best efforts basis, just replace S&P with S&P ESG, so you replace the E-money with the S&P ESG. If you were to replace European equities with Eurostocks, or let's say just kind of the one contract with Eurostocks, on a best efforts basis, you can really start to have impact for those people who want that. And the nice result as well, this was on a small data set and it was very rudimentary analysis. But if you replace those standard equity index futures with their ESG counterparts, you don't have any return drag either. You get the same kind of returns out. In fact, in the small space I looked at, the time window, you get a slight pickup. So, it's getting exciting because of that growth in volume and open interest that we can actually kind of now respond in futures world with tradable ESG equity index futures. But otherwise, we've long kind of restricted exposures at the request of clients. So, for example, if you're a certain type of European investor, you'll probably need to restrict grains anyway and rice and so forth. We can kind of do that and kind of put that as an optimization constraint. For some investors, they just don't want fossil fuels, and so we can leave out energy and so forth. So, there's the option to customize in that way by removing. But what's exciting, I think, is the option to customize and make things more ESG friendly by inclusion as well, but rather than just excluding, which I think is a really good path that we're on.
Thanks. Ella, anything to add?
I think a lot of the points are already discussed, but maybe just two quick observations from my end, because I've been involved in ESG or responsible investing, if you will, from my Mercer days. We did rate managers, and we're talking about roughly 10 years ago, on ESG. So managers not only had an investment due diligence on the rating, but we also did an ESG due diligence. We had a framework. Little I knew back in the day that there was nothing standardized, and we grappled with the idea of, does it add value? Is it an elimination? Do you add something? Can you actually come up with a return or value add prospect for responsible investing, or the E or the S or the G? So here's, after 9 years, here's what I observed. And I've been in entities where we did ESG, or we tried to do ESG, we tried to implement it. So it's really front and center, but it hasn't really changed. I think it's going from just public to private markets. So that's one important piece. Even though we made progress, I think we're very, very far away still from quantifying consistently. We can quantify it if you just take out energy, or if you just put the grains or remove the grains, or if you do fossil fuel or not, you can quantify it. But the consistently quantifying it and the impact from what the E is, what the S is, and what the G is really not here, right? And lastly, I think E seems to be taking over the S and the G. And given the non-standardized analytics, it's very difficult to calculate the potential impact. And therefore, each institution is creating their own investment and risk factor framework. I mean, we did this, it's just out there. You might have already seen this, but you might have just a couple of days ago, actually on November 1st, CFA just published the Global ESG Disclosure Standards. So this is the first global voluntary standards for disclosing, as they put it, how an investment product considers ESG. But I think the standards need standardizing, because there's so many frameworks out there. And the way the entities that I've been have thought about it is using the risk factors. So I think the way to implement it, I think that was one of the questions we had, into the total portfolio. Total portfolio, as I mentioned earlier, is not really asset class driven, it's risk factor driven. So we had some work, and it's proprietary at this point, so it's not finalized yet. But the idea is to break ESG into risk factors, and it's the main risk factors, whatever they might be, macroeconomic, and bundle it as such under the total fund approach. So if it's growth, if you're looking at emerging markets, right, you can actually apply that into if you're going to do an optimization, into the optimization or into your portfolio construction process. The problem is, it's not guaranteed that you're going to get better risk-adjusted returns, right? So that is the issue, because these frameworks could end up in a different place than where you intend to be. I think that's causing a lot of the issues, because when you're actually, let's say you're removing energy, right? If you did do that, great for last couple of years, and not so great for this year. I mean, depending on where we end up, right? So it's not really black or white yet.
Great, thank you. So I know we're coming. Well, we still have some time left, but we now, I think, topical. I think the poll results. Inflation. Top of mind of everyone. Sort of, we're in it. In the thick of it right now. It's top of mind. Would love to, hear thoughts about how, currently positioning, strategies being implemented. What are you seeing and doing with portfolios? Maybe, Chris, do you want to take that to start?
Sure. Look, it's always good when you're on one of these webinars to plug your boss's paper. And so this has given me a perfect opportunity to do that. Pablo Calderini, our president and CIO, wrote a paper on different inflation regimes and their effect on the correlation between equities and bonds. And we all think of kind of equities and bonds being uncorrelated or slightly negatively correlated as just being a fact of life, right? But it's I think a lot of investors are concerned that no, in fact, kind of this was just a 20-year free lunch we've had, and in fact, kind of equities and bonds can be positively correlated. And in Pablo's paper, he kind of showed that the period of positive correlation, which went from kind of the kind of essentially 70s, 80s, 90s, kind of 30-year period, a lot longer than the last 20-year period where they've been negatively correlated. This period of positive correlation between equities and bonds could be identified by hawkish Fed policy and inflation shock, essentially. So I think kind of along with inflation, kind of the thing that's driving kind of investor concern, it isn't just inflation as a standalone, but could this herald the end of this free lunch we all investors have enjoyed of having equities and bonds in their portfolio, which have been naturally uncorrelated or negatively correlated? If equities and bonds have a substantial period of being positively correlated, we've all got a problem. And I think investors are preempting that and saying, where do I get the diversification that bonds used to give from now, if bonds are not going to give that diversification? If I've got a portfolio that's essentially 60-40, that used to naturally offset in terms of risk, and now it's all potentially going to drop like a stone together in a crisis, then where do I get my diversification from? Which is boosting risk mitigation strategies, but not necessarily the use of bonds within risk mitigation strategies. It's boosting investors to say, look, I'm probably maxed out on private markets. I've got this core that's going to be less diversified. What am I going to fit in the gap? And so it's back to completion funds again, but completion funds with very much a diversification, risk mitigation, and loss control objective, rather than just a kind of a portfolio efficiency objective.
Great. Judy and Ella,
Sure.
anything to add? Judy?
Well, the one thing that I find interesting is that it's been a long time since we've really considered inflation. People have sort of brought it up, but then it's sort of been ignored. I would say it's certainly the last 10 years or so. Interestingly enough, if you go back to the academic papers, and they are quite old now, they find that equities do very poorly in an inflationary period, which I think actually means that there are opportunities in active management. Because for someone that's really doing deep research in determining, say a long-short equity manager, deep research in determining whether a particular company is going to benefit or be really hurt by rising prices from suppliers and so forth, and they don't have market power. If you really do that research, I think you can get a lot of benefits from that. So I think that there are pockets of opportunities within different strategies, but it's based on the actual implementation and skills of the underlying managers. We do hear a lot about commodity investing in inflationary periods. And then AQR just came out with a paper on trend following. Should do well in inflationary periods, and we'll just have to see, how that goes.
Ella?
I think I echo a lot of what Chris and Judy mentioned regarding the privates. I think infrastructure and certain inflation-sensitive commodities. So for institutional investors with such inflation-sensitive assets already in their portfolios, great, very well positioned. But if you don't already have privates, well, you might be a bit left behind. But in fact, even if you have privates, as Chris mentioned, there's a limit on the privates. So you can't really just go full on 100% in privates, right? And you can't do just commodities because it's just one single instrument. So I think there are other opportunities. One of the things that I looked into in detail, and I think it could be pretty useful, is the risk parity managers that actually have an inflation focus, inflation protection. As you know, risk parity could actually use that, could have a focus on inflation. And that could be a good play for this period. Obviously, linkers and gold, if you prefer a more blunt object, which are coincidentally some of the potential instruments we had used for the foundation of the risk mitigation portfolio I described earlier. I think the bigger challenge, and as we all alluded to, is the it's not just the inflationary environment. And I started trading in Turkey in a stagflation. So we had hyperinflation over 100%. So that is really bad inflation, and it's not driven by demand or anything. It's very difficult to get in there. And I don't think we are, I think we're in inflation, but I think it's not going to be permanent. So, but the bigger problem right now is the lower returns and the lack of insurance and protection from the government bonds for the reasons that Chris actually mentioned. So I think there's a decent chance that bonds may join equities on the downside in an inflationary environment. And therefore, I'll just echo what we said earlier, that risk mitigation, completion portfolio kind of strategies are really, really crucial.
Great. Thank you. So I think one of our, one of my final prepared question was, and we can keep this quick, and maybe we can only, maybe we have one response for this, is from each of you is, what are investors asking for right now? What do they seem to want and need as they are looking at their portfolios? Judy?
Diversity. We're seeing a lot of questions being asked there. Diversity in terms of the investments and the underlying managers that are being used, and then also questions on increasing the diversity of their staffs.
So at their own firm.
Exactly.
Right. Okay. And are they looking to hire, HR consultants, specialists, or how are they thinking about it?
It's interesting. On the investment side, it's more just really sort of taking, I would say, a broader look, and maybe sort of, loosening some of the restrictions that a lot of investors have, say in terms of track record, personal investment in the fund and all of that. And then in staff, it's also, again, extending their reach, looking beyond, if you're recruiting at the different universities, extending, the sort of universities that you come in contact with to get a more diverse base to choose from.
Great. Chris, what have you been hearing from investors? What's the one thing that they're looking for?
On a portfolio basis, there's definitely been a shift from looking for uncorrelated elements to put in the portfolio to elements that have a downside diversification benefit. So people are looking from correlation to conditional correlation in down markets, in line with the whole risk mitigation argument, in line with kind of the worry about equities and bonds and so forth. So very much downside diversification, but also kind of in terms of ESG, I think kind of people are looking for ESG product, but also in line with what Judy was saying, that they're looking for their investment managers to be good kind of good corporate citizens, essentially, who practice what they preach in terms of ESG.
Great. And Ella, to answer the final question.
It's the equity downturn. So how do you actually offset the equity downturn? Conditional beta, or reducing the capture, downside capture, and more esoteric strategies that are worth paying the active fees for. So fees, anything that's actually cheaper that can be implemented better and could capture that value add at the total fund level.
Great. Thank you. Yeah.
Well, I can't believe you got through that agenda, because it was fulsome and I had some doubts, but you really roared through it. I think the audience poll went very well. There were some great answers there. I want to thank Stephanie and Ella and Chris and Judy for a fantastic session, and thank everybody who has been watching or listening. There's a couple questions we didn't get to. Maybe you guys can follow up later. Thank you all very much. We're going to take next Friday off, but we will be back November 19th with all about ESG. So those of you who are interested in that, please join us. But otherwise, everyone have a wonderful weekend. Happy November, and see you next time. Thanks.
Thank you.
Bye.
Bye.